Hello viewers, today's topic is on the series of microfinance in India and population. In this program, we are going to learn about the Asian microfinance in the global context, recent history of microfinance in India, definition of microfinance institutions, and the major models of microfinance initiatives. So let's begin. First of all, we are going to see the Asian microfinance in the global context. Asian microfinance stands at the edge of industry's global ambition to augment financial sector inclusion. While Asian institutions combined here show less than 1/4 of the total global data set, they serve over 2/3 of the total borrowers. Four huge microfinance institutions take the limelight with an average outreach of 4 million borrowers each. These Asian colossus, Grameen Bank, Bank Rakyat Indonesia, and a few other Indian institutions stand supreme in scale of service. Asia is the most developed continent in the world in terms of volume of microfinance institutions activities. The generalization certainly covers up some broad disparities within the region. East Asia is better served by microfinance institutions. The widest number of members served and the widest distribution of advances and mobilization of savings in terms of gross national product was found in Vietnam, Indonesia, Bangladesh and Thailand. The two most populous nations in Asia, that is India and China, have very low outreach despite a wide concentration of the region. Countries such as Afghanistan, Myanmar and Pakistan also have low outreach due to a variety of factors. Despite these disparities within the region, overall it is said that microfinance institutions have flourished in Asia and that compared to other regions they display good outreach and wide repayment rate. Looking at the recent history of microfinance in India, we see that microfinance operations is not a new concept in the financial transactions. There were different forms of credit and lending activities that exist in different parts of the world since the development of human history. All these indigenous financial institutions were conducted microfinance activities in one way or the other. But modern types of microfinance were started its development since later half of 20th century, especially after 1970. Our country also witnessed the development of such institutions in the same period. Government's initiative to reduce poverty by improving access to financial services to poor started since independence. India's overwhelming majority of poor is located in rural areas, and this motivated the government to give special attention to rural credit. Following the report of All India Rural Credit Survey in the mid-1950s, the government took crucial steps in reviewing corporate structure, including partnership of state in cooperatives. Also, the policy initiative of social banking concept led to nationalization of commercial banks, adoption of direct lending programs to rural areas, and development of credit institutions such as regional rural banks, the RRBs, the National Bank for Agriculture and Rural Development. The microfinance sector has emerged mostly from the efforts of non-government organizations, that is the NGOs, and as a response to the failure of existing structures to deliver financial services to the poor. The efforts by NGOs have emerged from grassroots and represent diversity. They do not fit into a straitjacket. Therefore, unlike the other structures like cooperatives, regional rural banks and commercial banks, it is difficult to get statistics on microfinance. It is also difficult to make policy recommendations that impact the sector as a whole. There are different channels of microfinance services in the country. SHG, that is Self-Help Group Bank, Linkage Channel is the first one, which was developed in the early 1990s by the NABARD. More recently, many non-government organizations, community-based organizations and self-help groups have started microfinance diversity systems successfully in rural areas. These organizations motivate the poor to join the credit groups, help to manage their savings, loan deposit and recovery process, and may also provide an interest-free loan to the group that act as a start-up fund. The second channel is the microfinance institutions, that is the MFI. The MFI in India was first introduced in 1974, but the momentum was achieved only during the 1990s. In the country, Self-Employed Women's Association Bank is the oldest microfinance organization. It was founded in 1974 in Ahmedabad, Gujarat, as a trade union first. Initially, the formal financial institutions were reluctant to be involved in the microfinance institutions, and social entrepreneurship was also in short supply. But after 1990s, banks and other financial institutions, helped by supportive public policies, have become more aware of the commercial viability of microfinance services. Innovative partnership models have been developed between the banks and the microfinance institutions. These have pumped huge funds into the sector and have subsequently enabled the microfinance institutions to increase their scale of operations and outreach. It has witnessed tremendous growth of microfinance over the last 2 decades. A microfinance information exchange survey involving 78 countries revealed that India's microfinance sector saw the largest per microfinance institution percentage increase in activities borrowers in 2005 than any other country. According to the microfinance sector report of the Axis Alliance, the microfinance institutions' operations expanded by 13 times in 4 years to end the year 2009, whereas there was only one for-profit microfinance institutions in the country in the middle of the 1990s. This number has spiraled to 149 registered microfinance institutions by 2009. Of these, about 11% of the large microfinance companies had a disproportionately large share in the credit market, having 82% of the clients and controlling about 88% of the loan portfolio. Microfinance refers to a movement where the low-income households have permanent access to a range of high-quality financial services to finance their income-producing activities, build assets, stabilize consumption, and protect against risk. These services are not limited to credit, but include saving, insurance, and money transfers. The term microfinance is of recent origin, though one does not find this word in textbooks dealing with finance and financial management. But nowadays, it is freely used in the media, national, international forums, literature relating to development and prosperity of relatively disadvantaged sections of the society, etc. Microfinance is defined as the financial services such as saving account, insurance fund, and credit provided to poor and low-income clients so as to help them to raise their income and thereby improve their standard of living. From this definition, it is clear that the main features of microfinancing are as follows. Loan are given without security, loans to those people who live below poverty line. Even members of self-help groups enjoy microfinance. Maximum limit of the loan under microfinance is Rs 25,000. The terms and conditions given to the poor people are decided by NGOs. Now, microfinance is different from microcredit. Under microcredit, small amount of loans given to the borrower. But under microfinance, besides loans, other financial services are provided such as savings accounts, insurance, etc. Therefore, microfinance has wider concept as compared to microcredit. Microfinance has become in recent years a fulcrum for development initiatives for the poor, particularly in the third world countries. It has been practiced in varying forms in different countries, and it has been regarded as an important tool for poverty alleviation. Although microfinance could possibly include a range of financial services targeted to the poor, in common practice, however, microcredit and microfinance are often used interchangeably with emphasis on provision of credit to poor. Now, viewers, we are going to look at microfinance in India, its scopes and limitations, and the definition of microfinance institutions. The proposed Microfinance Services Regulation Bill of India defines microfinance services as providing financial assistance to an individual or an eligible client either directly or through a group mechanism for number 1, an amount not exceeding Rs 50,000 in aggregate per individual, for small and tiny enterprise, agriculture, allied activities including for consumption purpose of such individual. Or number 2, an amount not exceeding rupee 1,50,000 in aggregate per individual for housing purposes. Or number 3, such other amounts for any other purpose mentioned at terms 1 and 2 above or other purposes as may be prescribed. The bill further defines microfinance institution as an organization or association of individuals including the following if it is established for the purpose of carrying on the business of extending microfinance services. Point number 1, a society registered under Societies Registration Act 1860. 2, a trust created under Indian Trust Act 1880 or public trust registered under any state enactment, government trust or public, religious or charitable purposes. Third, a cooperative society, mutual benefit society, mutually aided society registered under any state enactment relating to such societies or any multi-state cooperative society registered under the Multi-State Cooperative Societies Act 2002, but not including a cooperative bank as defined the Banking Regulation Act 1949 or a cooperative society engaged in agricultural operations or industrial activity or purchase or sale of any goods and services. Microfinance institutions have witnessed enormous growth during the last couple of decades. The consultative group to assist poor under the United Nations has given 11 key principles of microfinance, and these are: first, poor people need a variety of financial services, not just loans. Second, microfinance is a powerful tool to fight poverty. Third, microfinance means building financial systems that serve the poor. Fourth, microfinance can pay for itself and must do if it is to reach very large numbers for poor people. 5. Microfinance is about building permanent local financial institutions that can attract domestic deposits, recycle them into loans and provide other financial services. 6. Microcredit is not always the answer. Other kind of support may work. 7. Interest rate ceilings hurt the people by making it harder for them to get credit. 8. The job of government is to enable financial services, not to provide them directly. 9. Donor funds should complement private capital, not compete with it. 10. The key bottleneck is a shortage of strong institutions and managers. 11. Microfinance works best when it measures and discloses its performance. Looking at the objectives of microfinance, we find that the organizations working to promote microfinance institutions in different parts of the world determine various objectives to microfinance. The important amongst them are listed as follows: promote social economic development at grassroots level through community-based approach, develop and strengthen people's groups called self-help groups and facilitate sustainable development through them, provide livelihood training to disadvantaged population, promote activities which have community participation and sharing of responsibilities, promote programs for the disabled, empower and mainstream women, promote sustainable agriculture and ecologically sound management of natural resources, organize and coordinate networking of grassroots level organization, get benefits by reducing expenditure and making use of local resources as inputs for livelihood activities, increase the number of wage days and income at household level. Now viewers, we are going to look at the major models of microfinance initiatives. There are broadly 12 various models of microfinance institutions working in different countries. This classification is on the basis of regulatory structure and operational methods. Few models are not common in international level and few others are complementary. The NGOs and self-help groups are example. Most of the self-help groups have a promoter, NGO. At the same time, many NGOs have direct microfinance chains. Like that, commercial banks are implementing microfinance operations through the self-help groups. In these cases, two models are working together to serve the poor. Some models are working in the informal sector only. Major models are Grameen, Village Bank, Credit Union, cooperatives, self-help groups, commercial banks, non-banking financial corporations, association of persons, Nidhi model, community banking, the NGOs, and rotating savings and credit association. There are several legal forms of microfinance institutions. However, firm data regarding the number of microfinance institutions operating under different firms is not available. Therefore, there is no uniformity in the number of microfinance institutions from various sources. It is estimated that there are about 1,000 NGO microfinance institutions and more than 20 company microfinance institutions. Further, in Andhra Pradesh, 30,000 cooperative organizations are engaged in microfinance activities. However, the company's microfinance institutions are major players accounting for over 80% of the microfinance loan portfolio. There are more than 2,000 NGOs involved in the NABARD SHG Bank Linkage Program. Out of these, approximately 800 NGOs are involved in some form of financial intermediation. Further, there are 350 new generation cooperatives providing thrift and credit services. During the last decade, the union and state government has considered microfinance as a tool to meet the financial service requirements of the poor. It has framed policies that enabled the increased access to financial services for the poor. Series of measures are introduced for the same. The following have been the significant initiatives. Encouraging National Bank for Agriculture and Rural Development to set targets for the Self-Help Group Bank Linkage Program. Emergence of SIDBI Foundation for Microcredit as a financer of microfinance institutions. The pronouncements of the Reserve Bank of India from time to time, such as including lending to self-help groups as a part of priority sector targets, exempting non-profit companies doing microfinance from registering as in non-banking financial corporation, permitting the establishment of local area banks, now withdrawn, setting up of the Rashtriya Mahila Kosh to refinance microfinance activities of the NGOs, rooting some poverty-oriented schemes such as Swaran Jayanti Gram Swarozgar Yojana through self-help groups, the close linkage built by the DWCRA schemes, the initiatives of various state governments in promoting schemes such as Swashakti Gujarat, Velugu Andhra Pradesh, etc. Now viewers, we are going to see about the outreach and sustainability of microfinance. The depth of outreach is defined as the proportion of poor in the total members and the depth of poverty of the poor reached. There need not be exchange between working with the poorest and the financial sustainability. The key factors in the process are cost-effective targeting, administrative efficiency, field staff efficiency, and management information systems, incentive for client and staff, and customizing products with prices, interest rates to cover costs which the poor can pay. While saving should not be neglected, it should not be a major source of funds. Notwithstanding the policy, there is not much of credit flow from banks to microfinance institutions because of the following reasons. Banks are rewarded for high volume of business. There are no appropriate microfinance products. Bankers' perception of risk is based upon past experience. There is absence of performance standards to evaluate the microfinance institutions. There are limitations of institutional structure which confines the non-government organizations. Now viewers, we are going to see women empowerment through microfinance. At the micro level, women empowerment refers to involvement of women in decision making, earning and sharing of food, cloth, housing, education and health facilities, and commanding respect for self and members of the family. At the macro level, women empowerment refers to participating in decision-making processes and commanding position along with the male partners in social, educational, economic and political affairs of society. Along with women participation in decision making, increasing employment opportunities and income, raising level of education, training and skill, raising standard of living, raising social status of women, increasing number of women in state governance is women empowerment. Thus, equal participation of women in the field of social, educational, economic and political is women empowerment. The economic empowerment of women through microfinance leads to empowerment of women in other fields too. The focus of women's empowerment in the context of microfinance brings to light the significance of gender relations in policy development circles more prominently than ever before. Women are working as a weapon against poverty. The rationale for providing women access to microfinance services is that gender inequalities inhibit economic growth and the development, according to the World Bank, the United Nations Development Programme. Hence, the Canadian International Development Agency provides increased access to productive assets, especially land, capital and credit, processing and marketing for women. Critics of the development perspective argue that the policy development approach to empowerment is extremely instrumental. As Cornwall put it, women's empowerment is heralded as a means that can produce extraordinary ends. Their empowerment extolled as a solution to the host of entrenched social and economic problems. The predominant image of empowerment in development is that of women gaining material means to empower themselves as individuals and putting this to the service of the families and communities. This is primarily because empowerment is understood in relation to deliberate and planned interventions such as electoral quotas, education, economic empowerment initiatives, legislative change, and non-governmental public action. The alternative perspective emphasizes that women's empowerment emerges, number one, as a result of cultural, economic, and other changes, such as the availability of new technologies in their lives, example, mobile phones and satellite television. Number two, as women's current opportunities and constraints. Number three, as a process in time across generations. Since the context of women's lives matters and the same interventions are not effectively everywhere, most of the policies remain ineffective. The experiences of empowerment and disempowerment are related, not just to material means and interventions, but also to social relationships, narratives, voice, choice, and negotiations. This critique is well reflected in the three paradigms of women's empowerment through microfinance. Number one, feminist empowerment paradigm. Number two, financial self-sustainability paradigm. And number three, poverty alleviation paradigm. It is not that microfinance institutions do not pay attention to women's empowerment issues. However, they do so marginally by adhering to the latter two paradigms. In the financial self-sustainability paradigm, women's empowerment strategies are seen as entailing unacceptable costs, as the paradigm's explicit aim is to develop fully financially self-sufficient microfinance institutions. In the poverty alleviation paradigm, women's empowerment is seen as an external imposition by Western-influenced middle-class feminist elite with little relevance to the needs of the poor women. It is also seen as politically sensitive and involving conflicts within households and communities that may undermine organizational sustainability. Both paradigms perceive conflicts between women's empowerment and development aims. Thus, the feminist paradigm, where the central concern lies in promoting gender equality and human rights, has been emphasized as an effective route to women's empowerment through microfinance institutions. Although microfinance programs adhere to the latter two paradigms, there are arguments on why microfinance institutions should adopt empowerment approaches. Firstly, microfinance practices do not always produce automatic empowerment benefits for women. Therefore, empowerment must be strategically planned for the microfinance institutions. Secondly, empowerment approaches allow microfinance institutions to realize their full potential in contributing to a number of critical dimensions of women's empowerment. Finally, empowerment approaches are often compatible with other approaches to microfinance, for example, financial sustainability, and can actually enhance the aims of these other approaches in many cases. An agenda of targeting women for loan access and detaching the empowerment aspect would thus be an anti-poverty strategy that is not only rationally unmusical but also morally incomprehensible. For this reason, the agenda for microfinance institutions should be to develop useful linkages between the functions of the microfinance institutions and their empowering their potential. So viewers, in today's topic on microfinance in India and population, we have learnt about the Asian microfinance in the global context, recent history of microfinance in India, definition of microfinance institutions and the major models of microfinance initiative. Thanks for watching the program.